It's time to go deeper into crypto regulation. For a long time, crypto regulation in Europe was fragmented. Each country applied its own interpretation of financial and AML rules, creating regulatory gaps and inconsistent supervision across the region. This fragmented approach made it difficult to oversee crypto asset activities effectively and allowed similar risks to be treated very differently depending on the jurisdiction. To address this, the European Union introduced the Markets in Crypto Assets Regulation, commonly known as MiCAR. MiCAR was created to establish a unified regulatory framework for crypto assets and crypto asset service providers across all EU member states. Rather than leaving interpretation to individual countries, MiCAR sets common rules, expectations, and responsibilities at the European level. Understanding MiCAR is essential for anyone working with crypto compliance, financial crime prevention, or regulatory risk in the EU. Because from this point forward, crypto is no longer operating in a regulatory gray area, it is operating within a defined regulatory perimeter. Before MiCAR, crypto regulation in Europe was a mess. Each country had different rules, or no rules at all. In the Netherlands, you only needed to register with the central bank. In Germany, you needed a full financial services license. In other countries, the requirements were much lighter. This created a loophole. Crypto firms would register in the easiest jurisdiction, often places with limited supervisory capacity, and then serve customers across the entire European Union. When things went wrong, no one could effectively intervene. Local regulators lacked jurisdiction. Host regulators lacked resources. The result was customer losses and almost no accountability. MiCAR was created to fix this. One framework. The same rules everywhere. A single license to operate across the EU. It's not perfect, and we'll talk about its limits, but it puts an end to regulatory shopping. MiCAR replaced 27 national crypto regimes. But what actually changed? 3 things. First, common definitions. Crypto asset services now have the same language across the entire EU. No more country-by-country interpretation. Second, a single license. An authorized firm in one EU country can now operate across all 27. No more regulatory shopping. This passporting right means a single authorization provides access to the entire European market. Third, coordinated supervision. Regulators now share information through ESMA, the European Securities and Markets Authority. The shift is clear, from regulatory arbitrage to regulatory parity. Every firm, the same standards. MiCAR creates consistent oversight and real accountability across the region. MiCAR rolled out in phases. The first milestone was December 2024. From that date, the stablecoin rules under MiCAR became applicable. Stablecoins were prioritized because of their systemic risk. With more than 100 billion euros in circulation, failures in this segment could directly impact traditional financial markets. The second milestone is June 2025. This is when the general rules for crypto asset service providers apply. Licensing, governance, conduct, and operational requirements all become effective at this stage. The final milestone is July 2026. This marks the end of the transition period. After that date, crypto firms operating in the EU must be fully authorized under MiCAR or stop serving EU customers. The key takeaway is this: some obligations are already live, others are approaching quickly, and the transition period is not a comfort zone. Preparation takes time, and 18 months disappears faster than most firms expect. Who is regulated under MiCAR? A CASP, a crypto asset service provider, is anyone who provides crypto services professionally for clients. MiCAR defines 9 CASP service categories. The core ones are custody or administration of crypto assets, operating a trading platform, exchanging crypto for fiat or other crypto, executing orders on behalf of clients, portfolio management and investment advice, and transfer services, newly formalized under MiCAR. The key word is professionally. Holding crypto for yourself is not regulated. Writing open source code is not regulated. MiCAR also includes specific exemptions, such as central banks, certain public entities, and services provided only within a corporate group. But MiCAR does not look at labels. It looks at function. For example, a Telegram group admin who facilitates P2P trades and takes a commission. Not calling it an exchange does not exempt them. Function determines classification. In practice, CASPs need authorization, capital, governance, and ongoing supervision. Operating without authorization is prohibited. Stablecoins are treated differently under MiCAR. Unlike other crypto assets, they are designed to maintain stable value against fiat currency. They are used for payments, settlements, and as the main bridge between crypto markets and traditional finance. Because of this, MiCAR applies a stricter regime. First, e-money tokens, or EMTs. These are pegged one-to-one to a single fiat currency. Issuers must be authorized as credit or e-money institutions. Second, asset reference tokens, or ARTs. These are backed by a basket of assets. They face stricter rules, including segregated reserves and regular stress testing. If circulation exceeds €5 million, authorization becomes mandatory. This regime has already applied to issuers in the EU since December 2024. For example, Tether's USDT has faced progressive delistings due to non-compliance, while Circle's USDC, which meets EMT requirements, has gained market share. The message is clear. Stablecoins are not just another crypto product, they are a financial stability concern. Under MiCAR, operating without authorization is not an option. Licensing is mandatory. Unauthorized firms face fines, website blocking, and personal liability for management. Firms must apply to a national competent authority in an EU member state. Applicants must submit detailed documentation on business models, risk management, governance, and AML policies. Firms need initial capital, at least €150,000 for basic services, up to €750,000 for trading platforms. Regulators conduct fit and proper checks on shareholders and management, reviewing records and competence. The authorization process typically takes 6 to 12 months, depending on complexity. Key point: a MiCAR license is a commitment to continuous compliance, not just a one-time approval. Under MiCAR, capital requirements are not symbolic. They are a real barrier to entry. The amount of capital depends on the crypto services provided. For basic services like custody, the minimum is €150,000. For trading platforms, this jumps to €750,000. These thresholds reflect operational risk, client exposure, and systemic impact. Capital serves two purposes: ensuring firms can absorb losses, and signaling financial commitment. Firms that cannot meet these thresholds must raise funds, merge, or exit the EU market. Capital is a regulatory tool that determines who can operate and at what scale. Under MiCAR, licensing is not only about the company. It is also about the people behind it. Regulators apply a fit and proper assessment to ensure that those who control and manage a CASP are suitable to do so. This assessment applies to shareholders holding significant stakes, typically above 20%, as well as board members and senior management. Being fit and proper means more than having industry experience. Regulators review criminal records, past involvement in financial misconduct, and sanctions. They also assess financial soundness and professional competence. The goal is simple. Individuals who pose integrity, competence, or stability risks should not control or manage regulated crypto businesses. This is where some firms encounter difficulties. A strong business model and sufficient capital are not enough if key individuals fail the fit and proper test. Importantly, this assessment is not limited to the licensing phase. Fit and proper requirements apply on an ongoing basis. If a key person becomes unfit after authorization, regulators can require changes to management. Under MiCAR, accountability is personal, not just corporate. Under MiCAR, a crypto white paper is not a marketing document. It is a regulated disclosure document. Any issuer offering crypto assets to the public in the EU must prepare a white paper that meets strict regulatory requirements. The white paper must clearly identify the issuer, including the legal entity, management, and beneficial owners. It must explain the crypto asset's main features, the rights and obligations of holders, and how the technology works. Importantly, it must also disclose risks. This includes market risks, operational risks, technology risks, and any factors that could materially affect the value of the crypto asset. MiCAR places legal responsibility on the issuer for the accuracy and completeness of this information. Misleading, incomplete, or overly promotional statements can trigger civil liability. Investors who suffer losses due to incorrect disclosures may have the right to seek compensation. In many cases, the white paper must be submitted to the competent authority before publication. The key takeaway is this. Under MiCAR, transparency is not optional. A white paper is a legal commitment, not a sales pitch. One of the key benefits of MiCAR is EU passporting. Passporting means that once a crypto firm is authorized in one EU member state, it can provide services across all other EU countries without obtaining additional licenses. Before MiCAR, crypto firms often had to navigate multiple national regimes or rely on legal gray areas to operate cross-border. MiCAR replaces this fragmentation with a single authorization model. The home regulator remains responsible for supervising the firm, while host regulators are informed and can cooperate through European supervisory mechanisms. This significantly reduces administrative complexity, but it does not reduce regulatory scrutiny. Passporting is not a free pass. Firms must comply with MiCAR requirements in all jurisdictions where they operate, including consumer protection, conduct of business rules, and AML obligations. If a firm breaches the rules in one country, that information can be shared across regulators. Under MiCAR, passporting creates access, but it also amplifies accountability. One license opens the entire EU market. One failure can attract EU-wide regulatory scrutiny. A common misunderstanding is that MiCAR replaces AML rules for crypto. It does not. Article 63 of MiCAR makes this explicit. Under Article 63, crypto asset service providers must comply with existing EU anti-money laundering and counter-terrorist financing laws. MiCAR regulates the market structure. AML laws regulate financial crime risk. These obligations are cumulative, not alternative. This means that being licensed under MiCAR does not reduce AML requirements. It increases regulatory visibility. CASPs must apply customer due diligence, transaction monitoring, sanctions screening, and suspicious transaction reporting in line with AMLD5 and AMLD6. Failure to comply with AML obligations can lead to enforcement action under both AML legislation and MiCAR. In practice, Article 63 ensures that crypto firms are fully embedded into the EU's financial crime framework. There is no separate crypto AML regime under MiCAR. If you operate as a CASP, you are subject to the same AML expectations as traditional financial institutions, and regulators will assess them. MiCAR and AMLD5 and AMLD6 regulate different things, but they apply at the same time. MiCAR governs who can operate in the crypto market and under which structural conditions. AMLD5 and AMLD6 govern how financial crime risks must be identified. For crypto asset service providers, this creates overlapping obligations. The same activity can trigger duties under both frameworks. For example, when a CASP detects suspicious activity, AML law requires a suspicious transaction report to be filed with the Financial Intelligence Unit. At the same time, MiCAR may require the firm to notify its competent authority, especially if the issue reflects a control failure or operational weakness. This means two reporting lines for the same event. One to the FIU under AML law. One to the regulator under MiCAR. The key challenge for firms is coordination. Without clear internal processes, obligations can be missed, duplicated, or delayed. Regulators assess not only whether reports were filed, but whether they were timely, consistent, and based on effective controls. Under MiCAR and AML, compliance is not about choosing the right framework. It is about managing both, at the same time. The travel rule is one of the most operationally challenging obligations for crypto firms. Under EU law, it requires crypto asset service providers to collect, verify, and transmit information about the originator and the beneficiary of crypto transfers. This obligation does not come from MiCAR alone. It is mandated by the EU Transfer of Funds Regulation, aligned with FATF standards, and explicitly applies to CASPs. MiCAR reinforces this requirement by bringing crypto firms fully into the regulated financial system. In practice, this means that when crypto is transferred between regulated entities, identifying information must travel with the transaction. This applies regardless of transaction size. The challenge arises when transfers involve unhosted wallets or entities outside the EU. CASPs must implement controls to assess counterparty risk, verify customer information, and determine whether transfers can proceed. Failure to comply with the travel rule is treated as a serious AML breach. It can lead to enforcement action, sanctions, and restrictions on business activities. Under MiCAR and EU AML law, anonymity is no longer compatible with regulated crypto transfers. Compliance with the travel rule is now a baseline expectation, not a future requirement. One of the most common compliance failures in crypto is confusion around reporting. Under EU rules, suspicious activity can trigger more than one reporting obligation. A suspicious activity report, or SAR, is required under AML law. It must be filed with the Financial Intelligence Unit when a CASP suspects money laundering. An incident report, on the other hand, is required under MiCAR. It is submitted to the competent authority when there is a significant operational or control failure. The same event can trigger both. For example, a suspicious transaction linked to sanctions evasion must be reported to the FIU as a SAR. If that transaction was enabled by a monitoring failure or system weakness, it may also require an incident report under MiCAR. These are not interchangeable reports. They go to different authorities, serve different purposes, and follow different timelines. Regulators assess not only whether reports were filed, but whether firms understood which obligation applied and acted without delay. Under MiCAR and AML law, effective compliance depends on knowing what to report, where to report it, and when. Under MiCAR, marketing crypto assets is regulated. Promotional communications are not free-form content. They are subject to clear legal standards. Articles 67 to 72 require that all marketing communications be fair, clear, and not misleading. This applies to websites, social media posts, ads, emails, and any other form of promotion. Marketing must be consistent with the information disclosed in the crypto white paper. You cannot promise returns, minimize risks, or contradict regulated disclosures. MiCAR also requires clear risk warnings. Consumers must be informed that crypto assets are volatile and may result in losses. Importantly, responsibility does not stop with the issuer. Crypto asset service providers that promote products are also accountable for how information is presented. Misleading marketing can trigger enforcement action, including fines, public warnings, and restrictions on business activities. Under MiCAR, how you communicate is part of your compliance posture. Marketing is no longer just a commercial function. It is a regulated activity with legal consequences. MiCAR does not only regulate how crypto assets can be marketed. It also clearly defines what is prohibited. Certain practices are no longer allowed in the EU crypto market. Cold calling is prohibited unless the customer has explicitly requested contact. Unsolicited promotions, pressure tactics, or aggressive sales strategies are not permitted. Marketing that guarantees returns or downplays risks is also prohibited. Statements suggesting that crypto assets are safe, risk-free, or guaranteed violate MiCAR. Misleading omissions are treated the same as false statements. Leaving out material risks, fees, or limitations can trigger enforcement action. MiCAR also prohibits practices that blur the line between marketing and advice. Promotions that resemble personalized investment recommendations without proper authorization are not allowed. Violations can result in fines, public warnings, and restrictions on marketing activities. In some cases, prohibited practices can also raise broader conduct and governance concerns. Under MiCAR, compliance is not only about what you say. It is also about what you must not do. Under MiCAR, influencer marketing is regulated. Promoting crypto assets through influencers is no longer an informal activity. It is treated as a marketing communication with legal consequences. Any paid or incentivized promotion must be clearly disclosed. This includes sponsorships, referral fees, token allocations, or any form of compensation, financial or otherwise. Disclosures must be prominent, clear, and immediately visible. Hidden hashtags or vague statements are not sufficient. Importantly, liability is shared. Influencers can be held responsible for misleading or non-compliant promotions. Crypto firms and issuers are also liable for how their products are promoted by third parties. Failure to disclose paid promotions can trigger enforcement action, fines, and public warnings. In some cases, non-compliant influencer campaigns may also raise broader conduct and governance concerns. Under MiCAR, outsourcing marketing does not outsource responsibility. If you benefit from promotion, you are accountable for how it is presented. MiCAR does not regulate everything in crypto. One of its biggest limitations is decentralized finance, or DeFi. MiCAR applies to crypto asset service providers with identifiable legal entities. Truly decentralized protocols, with no central operator or controlling party, fall outside its direct scope. This creates a regulatory gap. In theory, a fully decentralized protocol cannot be licensed, supervised, or sanctioned under MiCAR. However, decentralization is not a label, it is a factual assessment. If a protocol is governed by a foundation, a company, or a group that controls key functions, regulators may treat it as regulated activity. This includes control over upgrades, front-end access, fees, or custody-like services. In practice, many so-called DeFi projects are decentralized in name, but centralized in operation. MiCAR does not resolve this ambiguity. Instead, it shifts the focus to who exercises control. Where control exists, regulation follows. Where it does not, enforcement remains limited. MiCAR generally excludes non-fungible tokens from its scope. NFTs that are unique and not interchangeable are, in principle, not regulated under MiCAR. However, this exclusion is not absolute. MiCAR looks beyond labels and focuses on economic function. If NFTs are issued in large series, structured to be interchangeable, or marketed as investment products, they may fall back within the regulatory perimeter. Fractionalized NFTs are a key example. When ownership of an NFT is split into fungible units, it begins to resemble a financial instrument or a crypto asset subject to MiCAR. Marketing also matters. If NFTs are promoted with profit expectations or investment-like messaging, regulators may reassess their classification. The takeaway is simple. Calling something an NFT does not automatically exclude it from regulation. Under MiCAR, uniqueness and function, not branding, determine whether an NFT remains outside the regulatory framework. MiCAR is a European regulation. Its scope is limited to the European Union, but its impact is not. Non-EU crypto firms can still fall within MiCAR if they actively target EU customers. Offering services in EU languages, marketing to EU residents, or onboarding EU clients can trigger regulatory obligations. Operating from outside the EU does not automatically exempt a firm from MiCAR. However, MiCAR does not provide full clarity on cross-border enforcement. Regulators cannot easily supervise or sanction firms with no physical presence in the EU. This creates practical challenges. Some non-EU firms choose to block EU users or restrict access to their platforms to avoid regulatory exposure. Others establish EU subsidiaries to operate under MiCAR authorization. The risk lies in partial compliance. Serving EU customers without proper authorization can lead to enforcement actions, access restrictions, and reputational damage. Under MiCAR, geographic distance does not eliminate regulatory responsibility. What matters is where your customers are, not where your servers are. MiCAR does not explicitly ban privacy coins. Assets like Monero or Zcash are not prohibited by name under the regulation. However, MiCAR requires crypto asset service providers to comply with EU anti-money laundering obligations. This creates a practical conflict. Privacy coins are designed to obscure transaction details, making it impossible to perform effective transaction monitoring, sanction screening, or travel rule compliance. Because of this, many regulated crypto firms cannot support privacy coins while meeting their AML obligations. As a result, privacy coins are often delisted, not because MiCAR bans them, but because compliance is not feasible. This is sometimes described as regulation by impossibility. The asset is not illegal, but regulated intermediaries cannot safely offer it. Under MiCAR, privacy coins expose a key limitation. When transparency is legally required, technologies built on opacity struggle to coexist within the regulated financial system. MiCAR fundamentally changes how crypto operates in the European Union. It replaces fragmented national approaches with a single regulatory framework. Under MiCAR, crypto firms are no longer operating in a gray area. They are subject to clear licensing, governance, and compliance obligations. Some activities are brought firmly inside the regulatory perimeter. Others, like DeFi, certain NFTs, and privacy coins, remain only partially addressed. This creates both clarity and limits. MiCAR improves market integrity, consumer protection, and regulatory accountability. But it does not eliminate risk, nor does it solve every challenge in crypto regulation. The key message is this. If you operate in the EU crypto market, regulation is no longer optional, indirect, or theoretical. In the next module, we will move from regulation to reality. We will examine enforcement cases, compliance failures, and what actually goes wrong when firms underestimate regulatory risk.